morning, everyone. Welcome and thank you for joining our webinar today. In today's webinar, along with Sudhir Pai, we have with us Anup Nayak from My Time Equity. Before we start the webinar, I would like to take this opportunity to introduce you to My Time Equity and Sudhir Pai. As an actively managed portfolio management and RIF firm, My Time Equity takes pride in being your dedicated partner on this financial adventure. Sudhir Pai is a fiduciary founding principal and serves as a fiduciary investment advisor representative for the firm. Before I hand over to Sudhir, I would like to take this opportunity to inform you that you can scan the QR code and join our WhatsApp community to get the latest update on equity markets, alternative investments, real estate, crypto, venture, and lot more. Before we start the webinar, as per our attorney's mandate, we have to show the disclaimer, and that is the reason I would like you to take the note of the disclaimer. During webinar, if you have any questions, you can please type them on the Q&A box, and we will have them at the end of the session. If you need Sudhir's help, please write to wealth@mytimeequity.com or call us at 972-330-2771. Over to you, Sudhir.
Thank you, Jyoti. Very welcome to all the viewers, listeners who are here. So this week was a short week. I was in New York and New Jersey. You must have seen my posting in the WhatsApp group. So went to the Wall Street, got some blessings, and had some good time with my family during the long weekend, and spent some time with clients in New Jersey and New York. So the short week looked pretty long because of all this, but it was a good week. For the market, we saw kind of volatile market. Friday morning, it gapped up so much, but then at the end, S&P ended up gaining just 0.3% for the whole week. Otherwise, it would have been up more than 1%, for the entire week. Nasdaq was up about 1%, and Bitcoin and gold gained nicely to almost 3%. But the week before that, we did not do our webinar on the previous Saturday, but the week before that, Bitcoin took a little bit of beating, but gold has been consistently performing along with silver. Now, what are the catalysts? And why is today's webinar titled Hype to Hedge? Because we think, given the seasonalities of September, and I'll take you through the chart of what has happened in the last 50 years in September. But overall, September is relatively a weak month, and the catalyst which came from Fed Chair Jerome Powell's Jackson Hole meeting was quite a dovish move, and the interest rate cut of 25 basis points was kind of crystallized. But till that happens, we don't know, but we have to look at all the numbers that comes out every week. And we saw the jobs data, coming out on Friday, and that kind of spooked the market a little bit. And we saw, the gap up that happened on Friday morning kind of fade away by end of the day, and the market ended red on Friday. So we have to see what happens next week. But as of now, we think, looking at seasonality, September is going to be either a flattish month or a down month, slightly down month. But at the same time, while seasonality is a good guide, it may not be a repeat of last 50 years, because September 17th is when the Fed rate cut will be very clear, whether it will be 25 basis points or 50 basis points. What will Fed chair say about the next few quarters of interest rate cuts, and what are they going to talk about? All the things that are going on with the governors, with the Fed independence, and all of that, right? So the market gets pretty spooked when it sees that the Fed is losing its independence and White House is putting a lot of pressure. So it will be a very interesting week, the week of September 17th. So the next week I think is going to be a busy week as well, and I will take you through the list of events that are going to happen next week. So with the dovish Fed, we saw good rallies in small caps, gold, and Bitcoin, and also because of all the geopolitical tensions that are going on between US, India, China, and Brazil and Russia. Gold seems to be getting accumulated by most of these countries, and that is where we are seeing gold and Bitcoin rally a bit. Not a lot on the crypto side, but a lot on the metals for sure. And coming to the mega caps, we saw Google and Apple gaining a lot of steam last 3 days because both the companies got clearance for their antitrust lawsuit, and Broadcom gave in spectacular results, and OpenAI also kind of came out with some press release that they are partnering up with Broadcom to get out with come out with their own AI chips, and with that we saw some kind of a concern with Nvidia. So Nvidia took a beating on Friday, but otherwise Broadcom was anywhere between 12 to 9% high on Friday, and overall the Mag 7 saw a good week last week. So US equities are rallying, and they are above their support levels. They are at all-time highs. So nothing to be concerned about except the seasonality factor and the uncertainties that are going on in the world. Next slide, please. Okay, so what happens in September? We had kind of touched on this in the last two sessions as well. August and September are usually down months, but September, as you can see on this slide, we have 4 columns. The first column shows what has happened since 1950 and past 10 years, 20 years, and post-election year, because we are in the post-election year right now. So if you look at the line for September, you see red numbers, in every column. So that this shows that September historically has been a down month. It is not that it is losing a lot of percentage points, but it will be a month which is not going to be very interesting. It will be choppy, sideways, and finally end up red. So for September 21st also is the time where astrologically a lot of changes are happening in the world, and there may be some corrections because of that, because astrology is nothing but emotions in people, and people emotions is what determines the market, buy and sell. So I personally think that September 17th onwards, which is basically the interest rate cut news coming out, I think there will be sell the news, which means market is going to get into some kind of a correction mode from 17th to end of the month, or also first 2 weeks of October, because the first 2 weeks of September traditionally are not good weeks, but I think it's going to be good weeks for us this year, and that may spill into October, because traders always look at making money by doing intraday trading, day trading, swing trading, so all of that trading causes volatility in the market, and the long-term investors, when they look at their accounts, they may see a red day or a red week or a red month. But overall, as I keep saying, nothing to panic about. The long-term trend is good, momentum is on. We are all above all kinds of moving averages, 21-day, 50-day, 200-day moving averages. So we are not concerned at all. Overall, this year I think is going to end positive. S&P is going to be positive and a double digit. But let's see how it goes. Nobody has a crystal ball. Next slide, please. So regarding AI, Sam Altman recently came to the public and he said AI is in a bubble. No, well, AI is in a bubble because very clearly, the multiple of S&P 500 is, uh, 20 plus. It is usually in the range of 18, 17 to 19. That is a healthy PE number for S&P, but right now it has crossed 20. which makes it a little bit of a concern because you are buying into something which is very expensive. And if you look at all other countries, or in the world, they are all at an all-time high and overbought kind of a condition. And particularly if you look at the 10 big stocks of S&P 500, uh, they used to represent around 20% over the last 10 years, but right now it is about 40%. So the weights of these seven companies have exceeded tremendously, and that is one of the concerns why there is a feeling that these indexes may take a beating, particularly S&P 500 with 40% weight, Nasdaq a lot more than that. So there might be that concern. So that's why they call this as a most hated rally for the stock market. There are more bears than the bulls. And what I believe, and what I'm trying to explain here, is this AI bubble may not be a bubble that will pop that soon. I think this bubble will continue to become bigger and bigger, and there will be a time, maybe 26 or 27, we don't know. It all depends on how things kind of progress between now and then. But we have to, that is where active management comes in. But if you look at the fundamentals of these companies, these large tech companies are very strong. They have huge cash flows. They are spending a lot of money on capital expenditure. Apple recently said that they are going to put about $600 billion. Meta said that they are building billions of dollars worth of infrastructure data centers. So these are not like the times when we saw 2000 or 2008, where a lot of internet companies which were zero revenue, zero profitability, were going and getting listed in the market. So that was the real bubble. But right now we have the bubble getting formed, but I don't think this is a bubble which will pop that soon. It will pop at some point, but I don't think it is this year. But again, these kind of predictions we make based on the data we see, reading that we do, and the forward price earning multiple, or the PE ratio of seven large companies, the max seven companies, is less than 27. And if you look at what happened in 2000s when the bubble was huge and it popped, the PE ratio was about 42. So we are in a pretty good shape right now. There is no real reason to worry, because these seven companies are the jewels of America, the innovation hub of America. And AI is real, AI is happening. And we see this, right? When you use Chat GPT, when you look at Perplexity, when you look at all the other search engines, there is so much happening with AI. And the concern of AI is the job losses. But I think AI is certainly not at a level where job losses can be immediate. But I think it will be sometime in 26 or 27, depending on how quick will this AI really ramp up, and how are the AI hallucinations, because these technologies also hallucinate. The hallucination problem needs to be resolved. This technology needs to be used in multiple sectors, have to become more mature. It has to clearly replace people. Before all of that, I think there is going to be a lot more money being spent in capex, infrastructure, creation of different types of hardware that are required for making this AI work, because it takes a lot of space, a lot of energy. So we are in short of energy right now. We are in short of data centers right now. So the infrastructure build up, I think, is going to happen this year and early next year. And after that is where the monetization of these AI companies will really happen. And that is when we'll get to know whether this is a bigger bubble than what it has to be. But till such time, it's not super concerned. But we will see, some small corrections in the market. And when I say correction, market can go anywhere, anywhere down between 3 and 20%. That happened during the Liberation Day. Corrections are good for us, because when the corrections happen, people who are sitting in cash will end up coming up to the market, and the market will see a lot more momentum coming back, and a lot more people will be invested in these stocks, and the growth will be healthy. Next slide, please. So why is hedge necessary? The topic for today is hype to hedge. We are certainly in a little bit of a hype of the AI, but we don't know whether it's a bubble that will pop that soon. But we seriously need to hedge our portfolio, because depending on your risk profile, depending on your age, depending on your need for your money, you will be in deep trouble if market tanks 20% and that's the day you wanted the money for your kids education, or that's the day when you wanted the money to be wired to your parents in a foreign country, right? So all of that calls for hedging of your portfolio, and we at My Time Equity try to hedge our portfolios by bringing in diversity. We bring in commodities like gold, silver, palladium, platinum. We bring in cryptos. We bring in multiple countries. So we bring in diversity in the portfolio, and we don't get out of the market completely, but we do park some cash when the market is kind of at all-time highs, and we think the momentum is getting lost. But till such time, no need to worry. But hedge is very important. You will have to ensure that your portfolio is hedged depending on your personal needs for your cash, as well as whether you're going towards retirement, whether you are trying to grow your portfolio, trying to generate income out of your portfolio. All of that needs to be taken into consideration before you decide how much of your portfolio need to be hedged, and hedged using what. Should you keep some cash? Should you put some money in commodities? Should it be internationally diversified, or should you buy things like the structured notes that we bring to the table, with the downside protection, with the much higher cap at the time of exit? So all of that is required to be thought through when it comes to using your money in the equity markets or for investments. And if you look at the gold, look at gold as a hedge. Gold has gone up by almost 36% for the year. Next slide, please, Jyoti. Gold is up almost 36% for the year, right? Friday's numbers, if you see, it is up 36% plus, and it outperformed the broad market indices. In 2022, when everything was down, even gold was down, but it was not as low as S&P 500 or Nasdaq 100. So gold certainly is a good hedge. Silver had a breakout, and it's growing even faster than gold, because the gold silver ratio is something that historically people have always tried to maintain. So silver is doing well. Platinum is kind of kicking off. Palladium is kicking off. Rare earth materials are kicking off. The overall material sector is kicking off. So hedging can be done using multiple equity portfolio, equity sectors, as well as metals and international diversification. Next slide. So news for next week, we have the 10-year bond auction, note auction, and then we have the 30-year bond auction on Wednesday and Thursday. So these bond auctions, note auctions really sometimes shake the Federal Reserve and the Treasury, because what if our bonds are dumped or nobody buys them? That concern always is there, because bonds are required for running the country. We have a huge fiscal deficit, so we need to maintain that balance. And we also have the CPI, or the inflation numbers for August, coming out on Thursday. Then we have the initial jobless claims also on Thursday. So these are the numbers which makes a big difference for the Federal Reserve to take a decision on cutting interest rate. Right now, everything is dependent on whether the interest rate will be cut on September 17th, and if it is an S, what percentage, and what is going to be the messaging from the Federal Reserve for the next few quarters, and overall which direction are we headed, or is Federal Reserve going to be late like always, and is the country going to get into recession, is the kind of question that the market is looking forward to on September 17th. So next week is a lot of data which will be used for the September 17th FOMC meeting. Next. So a quick look at our portfolios. Our portfolios did pretty well compared to the indices. Small caps really took off. Gold took off. Bitcoin positive 3%. Our portfolios, all of them did very well. And if you are in any of these models, you can either check it out on our portfolio page, or you can log into your Schwab or Interactive Broker account and see how it's doing. But if you're sitting on the sideline with cash, please talk to us, because we can help you put that money in the market in the right place, as well as other alternative investments that we are going to talk about next. Next slide. So we have the structured note for income, and this is with Nvidia, Palantir, and Tesla, all three S&P 500 stocks. And the trade date for this is September 17th. It's a 3-year note, and the income on this is 17.75%. And the downside protection we have for this is 40%. And this includes the 1-star feature, which means in these 3 stocks, if any one of the stock is positive, your money is safer than without that 1-star feature. And because we added that 1-star feature, the returns is around 17.75%. If we remove that, we can have more than 20-22%, but we decided to add that because of the benefit that it gives to the note. If one of the stock is positive, your money is 100% protected. If it doesn't have to be that all 3 stocks have to be positive. One stock being positive is more than enough for this note, and we have the memory features also included in this. If any months, if all the 3 stocks are down, more than 40%, and you miss a coupon, then you will end up getting it back if the market brings these 3 stocks back to the trade date price. So it's 4.43% per quarter. It has a 1-year non-call option, meaning bank cannot call it back for 1 year. So beautiful note and a risk mitigated note with 1-star feature and the memory feature. So if you are looking to invest in any of the structured note, let me tell you one thing. These notes are issued by the best banks in the US. So if you are very comfortable keeping money in a FD or a CD and you maintain thousands of dollars there, you can very well put thousands of dollars into this without any concern, because these are strong banks, and 2, these are strong companies, and we have multiple risk mitigations in this. So putting in 100K, 200K, 500K, $1 million in a note doesn't concern me at all, provided we have the right diversification in your overall portfolio. So it doesn't matter to me, if you are putting a lot of money from your portfolio, as long as your overall ratio in these 3 companies or one note does not exceed 3% of your net worth, which means if your net worth is $1 million, 3% is $30,000. So you can put up to $30,000 in this note without any concern. If your net worth is 5, you can put up to $300,000, $150,000. So think of it like one particular ticker. Even though it has 3 different tickers with multiple features, you can go in deep into this and earn that huge return, which is 7.75% per year or 4.43% per quarter. Next slide. So this note is good for those who are conservative, more conservative than those who would like to invest in Nvidia. This note is based on indexes. So we have S&P 500, we have Russell, and then we have the Stocks 500, Stocks 500, Stocks 50. Stocks 50 is basically the European index. So all 3 solid indexes, good companies, and companies which are going to really have a very good time once the interest rate cut starts happening. And this note has a 30% downside protection. It's a 3-year note, and this is an uncapped growth note. So growth note means, if you invest your money in S&P 500, a lot of my clients ask me, why do I need your service? Why don't I just put money in S&P 500 and sleep? Well, you can do that, but when the drawdown happens, which means during Liberation Day when S&P 500 went down 20%, you have no protection, right? And if you want to make more than S&P 500 with the 30% downside protection, this is the place to put that money. Because what this is doing here is this note, let's say you put 100,000 on September 9th in this note, at the end of 3 years, you will get 2.65 times the growth of these 3 indexes lowest performing index. Let's say S&P is up 100% in 3 years, Russell is up 200% in 3 years, and European index is up 300% in 3 years. So you get the lowest is 100, you get 265% at the end of 3 years. One other point for those who are joining for the first time to our webinar, all of these notes is highly liquid. We can always sell them in the private market and take our money out. So these are not illiquid investments. These have liquidity, not as high as a dollar currency would have, dollar note would have, but certainly, we can exit out of this note in 2 to 3 days, business days. So this is a good note for someone who is looking at growth, looking at huge growth, and who believe in 3 of these indexes, which is S&P 500, Russell 2000, and European top 50 stocks. And this is a 3-year note with a 30% barrier. And the trade date is September 9th, which means we have 3 more days, which means Monday we need to place the trade, and Tuesday we need to place the trade. So if you're interested, again, this is a note in which I would put in 500K or a million also, because these are indexes, and I can go up to 10% of my net worth in this note if I want to, because of the overall risk mitigations that are in place. Next slide, please. So this is a quick view for you about the next project that we are coming out with. It's about 40 homes that we have bought in Kansas City, very close to the airport. It's all rented. It's 90% plus rented. So we are bringing this portfolio to our clients. We may need about 10 customers who would put maybe 100 to 200K each and stand guaranteed to their portion of the loan. All the investors will be general partners, and this is going to be a $6.8 million purchase totally, of which 50% is already taken by me and my partners, and the rest of the $3.4 million is open for investors to come in. We will be presenting more sometime next week, or we may also send you an email about this project, but this is coming soon, and it's a beautiful project with very great returns, and 60% of your investment can be depreciated against your 2025 income. And these are single family, these are duplexes with tenants in them, and it's easy to manage because these are all like regular homes, and we are buying it at a very good price and for very good rental yield. So stay tuned. This will be presented in the next week's session. Next slide. We still have the XAI and Perplexity SPV open. So if you are looking to invest in this fund, reach out to us and we can get you in. We have good inventory that is available from some of our contacts in both these companies. XAI, I think we may have about 200K left, and Perplexity, we can get up to $1 million if you're interested in investing in it. The valuation of these companies are at a pretty good price point that is available in the market right now. We are buying the shares of XAI at about $113 billion. It is trending much higher for the next round. And if you have read the news, Elon Musk was successful in getting a $1 trillion package approved for his compensation from Tesla. If Tesla is doing well, SpaceX is doing well, and other companies of his are doing well, that means all the business of those companies when it comes to AI will go to XAI. And that's where this company has a potential to grow very big very soon because of all the Elon Musk companies becoming clients of this company. And Twitter anyways, is there as part of this deal. So this deal brings X and XAI both together at $113 billion valuation, which is 80 plus $33 billion total valuation. And Perplexity, which most of us use as an alternative to ChatGPT, we are getting this at $20 billion valuation. So if you're interested, please write to us at wealth@mytimeequity.com, or you can go click on this link and then type this link on your browser. And we also have posted a few messages in our WhatsApp group. So if you are late to the game here and if you are still interested, I think this will be the last opportunity. Next week, I don't think we will have this in the slide deck. So reach out to us ASAP. Next slide. And for that matter, also, I would like to request you, if there is any interest in investing in any other stocks like Grok, Anthropic, OpenAI, we have access to some of these companies through our family office network. So please email us or put a message in the chat box here saying you are interested in some of these companies and we can find it for you. Now, the minimum that I need to buy from the market because I am not going to get access to $10,000-$20,000 type of stocks, but I'll have to buy anywhere from $1 million to $2 million worth of shares, and then put it in SPV, and then have each one of you participate in it if there is interest. So please do let us know this. Think of this like some kind of a survey, and then just type in your message saying interested in this company, that company, and we'll keep that record and while negotiating with other family offices for shares. Last but not the least, we have the Caliber car wash. We have changed the car wash brand from Caliber to Mister's. Mister is a listed company. We were in contract to buy this particular car wash, but in the process of due diligence, we felt the tenant is not very strong, and we would not do any deal where there is any kind of risk. As you know, we are very risk averse, at the same time aggressive in our approach. So Caliber was not such a great brand, particularly the location that we were in contract with. So we canceled that contract, and we have signed up for Mister's Car Wash, which is a listed company, has about 400 plus car wash locations. So very strong tenant with guarantees that we are getting. So please talk to us if you had shown interest in this. But this Mister's Car Wash is going to be a much better property, and much stronger tenant, as well as a longer lease. So overall, better property, and that is what we do as part of asset management, right? We charge you fees for doing asset management, and that's where we make sure that we bring the right asset and manage it right and sell it at the right time. So the car wash is still available, because the property that we are in contract now is a lot bigger than this $5.36 million property. I think the new one is a $7 million property. So there may be scope for a few more investors if you're interested in getting into this. So what does this do? Why invest in car wash? Car wash gets you the benefit of a huge write-off in year one. The rule of thumb is, if you're investing 100K, you can write off about 200 to 220K in 2025. You will make about 4 to 5% income, and then there is going to be exit. At exit, we'll make money if we are selling it for higher price than that we bought it for. So this is a GP only deal. The minimums are much higher here. If you are looking for a car wash or a gas station type opportunity, but for a smaller chuck, less than $50,000, then we have the fund. You can always reach out to us and invest in the fund. But this property that I'm showing here, which is now replaced by Mister's, is a GP only property, which means 5-10 people come together and we buy this property. So we are in control. It's a single asset deal, but the fund will have a lot more properties. So if you're looking for diversification, if you're looking for smaller ticket size, the fund is the way to go. Next slide, please. Okay, that brings us to the end of today's webinar. Guys, if you're not joined our WhatsApp group, please scan this QR code and join our WhatsApp group today. It will be very helpful for you to get updated with the latest. Every day we post a message giving the summary of equities, crypto, and other markets, as well as we bring all these opportunities first in the WhatsApp group. So please join our WhatsApp group. Now I think we are going to open it up for questions. Over to you, Anup.
Good morning, Sudhir. Yet to see any questions being posted here, at least I'm not able to see.
Yeah, good. We have no questions. That means our listeners have become very, very intelligent and smart. That is good. That is our goal, right? To educate so much that there are no questions. So great. So you have any answers that you want to start with, then come up with a question, Anup?
No, right now that's what. Only thing is we spoke about XAI. That is timing is essence here. Likewise, one of the structured notes is being traded for next week. That is, I think these are the two priority, I would say, for the week for now. And yeah, there's one question coming up now regarding the Kansas City expected returns. I think more will be there next week, but there's what is expected returns on the Kansas City project, Sudhir?
So we are buying this project for around 8.5% cap rate, and we are restricting the distribution to 5% per year, so that we have some buffer in case of any repairs and contingencies. This is not a triple net property, so we are responsible for any, but it's a new property. It's a 2025 property. So and 40 properties together, all newly built. But still we are maintaining the distribution percentage at around 5, but I think the free cash flows will be around 7, and we are looking for about 60% of your investment in first year depreciation, and then hold period of about 5 to 6 years.
Okay. The next question is, do you do options and generate income through covered calls? This other question.
As an organization and as a conservative person, I usually don't like to deal with options, because the level of attention that you need to do with options is very high. But that's where we do structured notes. Structured notes is also created using options. So if you look at some of our income-based notes, the yield notes that we showed, which is the Nvidia, Palantir, and Tesla note, that's a 17% return note. Now we use the bank's trading desk to create these notes. So we offer solutions to our clients. So instead of using options and generating incomes, we don't which we don't do. But if you're looking at a portfolio, if there is a portfolio of concentrated stock, let's say you are sitting on Meta stocks, $1 million plus, and you can't sell them, and we have to now look at what are the other alternative options. We can look at covered calls on those shares and try to generate income of anywhere between 1 and 4%, depending on the volatility of the market for Meta. And also we can do a tax-free exchange of those concentrated stocks with the fund that holds 500 S&P stocks. So private exchanges as well as covered call options for concentrated position is something we do. But for generating income, pure play income, we do structured notes, and that is how we run our wealth management practice. What happens if XAI doesn't go public? So there are secondary offerings that happens in the market. Like we are buying these shares from the secondary market. So if XAI does not go public for 5, 6, 7 years, but the valuation of it keeps increasing, and this is happening with SpaceX. When I first invested in SpaceX, it was 2021. We invested at $75 billion valuation. Today it's around 450. It's not going public. I don't think it will go public this year also. It may go next year or the year after that, depending on the the condition of the capital markets. But as long as these stocks are doing well, I am happy holding it, because I am holding it for growth, and I don't want to realize the gain and pay taxes on it. But now if there is a tender offer, if the market is up, we should be able to buy it from you and give you liquidity, if that is the question. Or if you're looking for liquidity in your portfolio, we have a fund called Stepstone Fund. We have XAI and Perplexity and all the companies in that. It's a liquid fund. You can exit out of it by giving 3 months notice. And if liquidity is a concern, we have that fund. If growth is the main thing and you are ready to hold this, even if the CEOs of these companies decide not to go public, investing in this SPVs is a good idea.
Yeah. So the next one is on the margin account. Can you explain the margin account stock investment?
Yeah, we do margin of anywhere between 15 and 40%. The margin model that you see on our portfolio page is anywhere between 0 and 40%. When the markets are in a correction mode, we may in fact hedge our bets by holding more cash. We did that during the Liberation Day, and we take actions when market goes below certain moving averages, but otherwise we are around between 20 and 40% in margin. We can take higher, but we prefer not to take higher given where the market stands today. I think 40% margin, 20% margin should give us good alpha and the interest rate that we pay to interactive brokers is around 4.5%. So it's not very expensive loan, and as long as markets are the trend is positive, we are comfortable with taking margins on that, but in that particular model.
Thanks, Sudhir. I think that also answers the questions the same client has posted on the risk mitigation. The last question, at least that I see here, is the management fee for the wealth management, and what is the minimum amount you take to manage?
Yeah,
So
our minimums that we like is 250K, but we don't mandate for that. We work with anybody who is coming to us for the first time, wants to start small with us. So the minimum that we mandate is $25,000. Below that, we would take only if it is hits accounts of a client who is already with us. And the fees that we charge for up to $250,000 is 2%. So it's like a penalty for doing less business with us. Anything more than $1 million, we charge 1%, and we don't negotiate our fees. And that's a fixed fee. And come to us with even $15 million, that would be the best fees that we would offer, given the service that we bring to you with multiple asset classes, tax planning ideas, and things.
thank you, Sudhir. I think that was the questions for today. Thanks again. I know it was a hectic week, but thanks for making it with the webinar. And with that, we are done. Thanks all.
Thank
Thanks,
you very much. Bye.
Thank you.